Welcome to PIMCO Pod. In this episode, we discuss why the Federal Reserve could further shrink its balance sheet, and why, if done gradually, markets may see little impact. Stay tuned after the conclusion of the podcast for additional important information. Why the Fed Could Shrink Its Balance Sheet Again, and Markets Might Not Notice, by Tiffany Wilding. Late last year, the Federal Reserve ended its latest quantitative tightening, QT, program, the process by which it shrinks its balance sheet by selling securities or letting them mature without reinvestment. From a peak size of almost $9 trillion, or roughly 35% of U.S. GDP, the Fed had reduced the balance sheet by more than $2 trillion. Unlike in 2019, when a spike in money market volatility prompted the Fed to abruptly halt QT, markets barely seemed to notice this time. The lack of reaction is important. As then-Fed Chair Janet Yellen phrased it in 2017, QT is meant to run quietly in the background, like watching paint dry. By that standard, the uneventful conclusion to this latest QT round looks like a success. So why then are some Fed officials, Governor Stephen Moran and other Fed staff, along with Fed Chair nominee Kevin Warsh and several academics and former Fed staff, including Bill Nelson of the Bank Policy Institute, all advocating for further reduction? Many argue that the interaction between post-crisis bank regulations and normal growth in banking deposits is likely to lead to an ever larger Fed balance sheet, unless policies are pursued to mitigate bank demand for reserves. There are ways this can be achieved, and indeed, the groundwork is already being laid to potentially restart a gradual process of QT as soon as later next year, in our view. If implemented in a gradual and predictable way, similar to past programs with constant monitoring of large bank demands, we think the implications for broader markets will also be similar to the recent experience: negligible. Demand for Fed liabilities drives the balance sheet. The size of the Fed's balance sheet ultimately reflects demand for its liabilities. As with any institution, the Fed balance sheet is made up of assets and liabilities. The asset side is mainly U.S. Treasuries and agency mortgage-backed securities. The liability side includes cash in circulation, bank reserves kept at the Fed, and the Treasury's general account. Since the GFC, the Fed has relied on balance sheet expansion to mitigate the limits of the effective lower bound on interest rates and provide further monetary accommodation. It has funded those asset purchases by issuing reserve liabilities to banks. The extent to which the Fed is able to normalize its balance sheet in better times depends on banks' demand for reserves and also on the public's demand for currency. Post-crisis regulations increased reserve demand by requiring banks to hold certain levels of high-quality, liquid assets, for example, reserves, to back a portion of their funding, of which a large portion is deposits. Because the business of banking is making loans and issuing lines of credit, which create deposits, banks' demand for reserves has continued to gradually grow over time as bank deposits have also grown. This has led to a larger Fed balance sheet, while the ratio of central bank liquidity to bank deposits has fluctuated within a stable range, as the Fed has expanded and contracted its assets for monetary policy reasons. Reducing the Fed balance sheet. Given the link between bank reserves and deposits, the Fed's balance sheet is likely to keep gradually expanding over time, even in the absence of asset purchase programs, quantitative easing, or QE. Some observers worry that if more isn't done to reduce bank demand for reserves, then the ever larger Fed asset holdings of treasuries needed to accommodate bank demand for reserves could distort market pricing, including in repo funding markets for treasuries, and reduce treasury market liquidity. In addition to the Fed's traditional responsibilities of being the lender of last resort, the Fed's ever-growing size within the Treasury market could increase the need for the Fed to be market maker of last resort in times of stress, which leads to questions of moral hazard. Various officials and academics have also shared concerns that an ever-expanding Fed balance sheet could blur the distinction between monetary and fiscal policy, which could threaten central bank independence. These concerns underpin recent research, authored by Moran with other Fed economists, that aim to reduce bank demand for reserves despite higher deposits. They quantify the menu of possible strategies that, if implemented, could reduce reserve demand by an additional $1 trillion to $2 trillion over time. These aggregate numbers overstate what is likely and feasible within the next year or two. However, there is a subset of strategies that could be implemented more quickly, freeing up closer to $500 billion in reserves, in our view. Making structural changes to how banks settle daily payments through the Fedwire Fund Service to reduce banks' need for liquidity buffers would likely take a few years to effectively implement. The Fed's latest 24-hour Fedwire services has been available for just under 3 years with limited usage. Other proposals would require reforms to the Treasury's general account management, which is out of the Fed's control. Still others require changes in the way the Fed implements monetary policy and would have market trade-offs, such as somewhat greater money market volatility, and would require active daily reserve management operations. Other strategies that require changes to the way the Fed implements large bank liquidity rules could have a tangible impact sooner. Specifically, the Fed could change its large bank liquidity, resolution, and stress test requirements to allow banks to assume usage of the Fed's discount window in severe stress scenarios. The Fed could also encourage banks to shift current reserve holdings to other high-quality liquid assets, for example, T-bills and short-dated agency securities, which could be pledged to the Fed as collateral for additional cash during periods of market stress. If the Fed encouraged banks to assume the use of these facilities, it could have the added benefit of destigmatizing their use. As the rules are currently implemented, the Fed requires banks to hold enough liquidity to survive GFC-like episodes without assuming usage of Fed liquidity facilities. While that increases the safety and soundness of the overall banking system by reducing the need for the Fed to act as a backstop in period of high stress, it has come at the cost of a large Fed balance sheet in normal times, a state some have described as overkill. Strategies to relax and more efficiently implement large bank liquidity regulations have already been put in motion by Fed Governor Michelle Bowman, the Vice Chair for Supervision. We believe regulators could propose changes to liquidity rules as soon as later this year and could take effect as early as January or April of next year. Monitoring and managing the impact. The Fed appears to be on its way to implementing policies that seek to reduce banks' demand for reserves. But how will the Fed monitor whether and how much bank reserve demand is actually falling? One sign would be small declines in money market rate spreads relative to the interest rate on reserve balances, IORB, paid by the Fed. In the years since the Fed's post-GFC balance sheet expansion, secured and unsecured overnight money market rates have tended to trade 5 to 10 basis points below IORB. As the Fed drained reserves, those rates traded more in line with IORB, or even slightly above. As these rates drift down again, that should signal that the strategies are working. However, even if money market rates ease, there is still a question of how much bank demand for reserves is falling. To get a better gauge, Fed bank regulators would need to continually survey large banks on their minimum comfortable levels. In order to restart quantitative easing, we think the Fed would, at a minimum, need to be relatively sure that bank demand for reserves has fallen by at least $500 billion, something that we think appears feasible in light of Moran's study. What does this mean for broader markets? Potentially not much if implemented gradually and with continued monitoring. Large banks will still be required to hold a portion of their assets in highly liquid securities. However, giving them more flexibility outside of reserve holdings would likely mean that reserve holdings would shift into Treasury securities. Banks would seek to maximize returns within the new framework, and now that the Treasury yield curve is upward sloping, banks have the incentive to swap reserves for higher-yielding, liquid Treasury securities. Various academic models linking Treasury supply to the term premium that investors require to hold those securities suggest limited impact on yields. Treasury could also shift issuance toward short-dated maturities to limit the market impact. Overall, this suggests that shifting bank holdings of reserves could be uneventfully absorbed by markets, like watching paint dry. Thank you for listening. That was why the Fed could shrink its balance sheet again, and markets might not notice. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcast may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.